Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. Been following his work for a number of months now. He's also good friends with another one of my new friends, Jim Iuorio. He does the co-host of the Futures Edge podcast. He's the co-founder of Path Trading Partners. He has over 22 years of experience as a professional trader. Also, I think he was chief market strategist at a number of banks. Bob Iaccino, thank you for joining me.
Good to be here, bud.
So, Bob, we're recording this interview on Friday, April 26, 2024. Let me get some market information first. The dollar index has rallied substantially the last month or so. It's up to 106.03. The 10-year U.S. Treasury yield has also spiked in the last couple of weeks. It's corrected a little bit from 4.7, but it's still high compared to 4.2% only a couple of weeks ago. It's up to 4.67%. And the gold price has rallied a lot in the last 4 to 6 weeks. It's way over $2,000 at $2,338. I want to get your thoughts first, though, on how trading has changed given your career, because I knew you worked a lot in Chicago. You traded on the Chicago Mercantile Exchange and the Chicago Board of Trade for many years, and also traded at banks. How has trading changed a lot with the new technologies, with like high frequency trading, 0-day options, retail traders trading on their phone, on Robinhood app? How do you think it has changed so much?
Yeah, it's changed a lot. I mean, obviously, I got to update my bio because of that 22 years thing. I started in late 1992. So we're coming up on, what would that be? Almost 32 years now, right? Well, whatever, not important. I started out on the floor of the CME group and spent some time at the CBOT as well. So I was a futures guy, but as you very well know, there's, stock index futures at the CME. And obviously one of the bigger products at CBOT is bond futures. And I also worked in the yen pit. So I got pretty much a wide sort of swath of sort of macro financial analysis under my belt in my early years. Worked at a prop shop, worked for several banks, including Commerzbank out of Germany, Smith Barney for a very short period of time, Nikko Securities out of Japan, bunch of different international banks. And I think, it was interesting. I left the floor in 2004. We were still making money at that point, but it struck me that I needed to figure out a new way to do this at the time because, you could see the end coming of the pits. And it's interesting because you had to find sort of a new crutch to lean on. In the pits, you could hear a sound and sort of interpret the sound. Like, for example, if everybody is selling, they would yell sold in the pits. And that had this sort of lower sound, whereas buy 'em had a higher pitch sound. And you could almost just hear the roar and kind of go into the market knowing which direction things were going things were going. So obviously, when you go to trade upstairs, that sound is no longer there. That was the main change for me, not something that other people necessarily experienced. But now it is so electronic and things happen in nanoseconds with the high frequency trading that the way trading changed from a perspective of successful trading, in my opinion, was to be successful as an individual trader back in my day on the floor, you were in and out quickly. To do it now as a retail trader, you need to shrink your position size and widen your time frames out and hold positions longer because the nanosecond traders that are trading decimals of decimals are way faster than you. You can't compete with those guys. You can't get in a stock at 100 and get out at 101. I mean, they've done millions of transactions in that dollar move, right? And you just can't compete with that. So I went from an average hold time of about 2.5 to 3 minutes to about 26 days now. That to me has been the major change. When I talk to retail traders, I try to tell them, look, you're a position trader now where you need to be because the speed that these guys are trading at, you can't physically do it.
And do you think things like people trading on their phone, Robinhood app, 0-day options, that's only going to exacerbate what you just described?
Yeah, it actually, to me, is a problem, to be honest. I mean, you saw a lot of people get hurt by the gamification of trading. I try to tell people all the time, look, the balloons, the congratulations, all that stuff, it's completely misplaced. I mean, the life of a successful trader is extremely boring. What's exciting is the life you create after working hours, right? Because you're able to have a lot more freedom. Hopefully, if you're good at it, you have financial security, financial independence, which, in my opinion, the government's trying to take away. But your actual workday is very boring. It's analysis and it's slow and steady. It's a waiting game, waiting for the right things to happen that fit your strategy. So when you get something like this, where Robinhood, you would just buy a stock and you get balloons and confetti. Like, how is that successful? Any broker on the planet will take your money and allow you to buy a stock. There's nothing, earth shattering about that. There's no congratulations that's appropriate for that kind of an act. So when they're gamifying you getting into a position, it hits the wrong part of the brain, in my opinion. That's been a struggle I've had with some of the clients that allow me to talk to their retail clients.
Well, especially a lot of people don't understand that if they have free trading, commission-free trading, that their data is the product. So like Ken Griffin at Citadel and others are taking advantage of that.
Yeah, it's not free, right? I mean, you don't get the best possible fill when you're having free trading. So you're paying for it, that plus your data, as you just said. So, I mean, easy example is, if the price of ABC stock, if the real market is 101 to 101 half, right? You're going to sell at 99 and you're going to buy at 102. And that's the difference in between, is what the market makers make. That's why you don't pay. I mean, obviously it's an exaggerated example, but that's why you don't pay commissions, because you're paying on your fills. You're paying on your entries and exits. Like, you're not getting the best possible price. There are some brokers out there, mostly institutional, but there are some available to retail who allow you to pay a commission, and then they guarantee you the best possible price they could get you. I honestly think that's a better option for most retail people, but I've sort of given that fight up.
Well, I think things are headed in the wrong direction, like what you described. And then Warren Buffett has even made comments on this, that everything is becoming more casino-like, more gamified. And then with smartphones, people basically now have what was way better than an old computer on their phone right now. And so you have tons of people trading on their phone. And then you add in sports betting. Tons of people are doing sports betting on their phone, and they're doing sports bets during the game. So I think like all these things are just feeding on themselves with growth of sports betting, growth of people day trading on their phones. All these things are together now.
I couldn't agree more. I mean, the casino aspect of it, you've got a lot of, like, two things that I don't think are really healthy. And I want to qualify what I mean by healthy after I say this. But number one is event contracts. Event contracts are skewed, right? So unless you're selling an event, because obviously it works the same as options, right? The only people who consistently make money are option sellers, not option buyers, right? But the option selling is where the risk is, naked selling of options. Same thing with event contracts. I mean, they're priced a certain way because they're enticing you to buy an option or buy, an event risk contract that has a small barrier to entry and a high payout. And those are the things that are least likely to happen. It's the same thing with, some options, naked options. So from that perspective, it works out very similar to sports betting, except sports betting, at least they're honest with the odds, right? Like, I saw, for example, the NFL draft was yesterday, right? And if you wanted to bet that the Bears were going to draft Caleb Williams number one, it was $20,000 to make $100. So you literally had to bet $20,000, meaning the money line was minus 20,000. So you had to bet $20,000 to make 100, right? So at least they're honest about it. You could have bet $100 to make 20,000, but you might as well just lit a $100 bill on fire. It would have been the same bet, right? And trading is, in a weird way, for people who are just starting out, a little less honest than that, right? Because they're not actually forthcoming with the odds if you don't understand volatility. And if you don't understand the structure of event contracts. Now, here's why I said I want to qualify that. Event contracts are kind of a fun augmenter for people like you and me who have experience trading, right? And have a position on, for example. If I have a position on in crude oil, right? And let's say that position is for lower supply and higher demand in the future. I could go to an event risk contract and I could bet against OPEC cutting more production, for example, or for it rather. And then it's just sort of a little bit of an augmenter, a little bit of kicker. Do you know much about craps, Jason?
My grandfather actually was a very good craps player. He learned during World War II. He used to get tons of stuff comped in Las Vegas.
Okay, perfect. So You can actually skew the odds in the player's favor in craps if you get past the first roll, which is called the come out roll. And then you start betting on the point, which is what the first roll was, as long as it wasn't 7 or 11. I won't go too deep into the weeds here. And you bet with the odds every single time. So there's certain odds you can do for certain points. And as long as you get past that first roll and you can take odds on your bet, the odds actually skew to the player. But on the first roll, it's way skewed to the house. So what people do is they start going on these little mini winning streaks. And then let's say the point is 8, they start betting 8 the hard way, meaning 2 4s, right? That's an event risk contract. It's a very unlikely thing to happen. But if it happens, it gives you a really nice kicker. So I say that it can be a nice thing for people who have more experience in trading to kind of augment a bet that's already going their way, right? A trade that's already going their way. But there's some individuals that's all they bet, right? Is they bet event risk. And I think that's unhealthy.
Oh, so it sounds similar to like a roulette wheel. Instead of betting on a color, you're betting on just a number then. So the
100%.
probability of the bet paying off is very, very low.
Very, very low. Now, again, I'm actually a fan of event risk contracts, but there's a huge context that we probably don't have time to go into. But I also don't like ODTEs. I don't like 0 day to expiration options for retail. And retail is just flocking to them. Right?
So do you think the reason is because what the institutional investor wants to sell those option contracts? So like the pension funds, the institutional investors, they want to make extra options premium selling?
100%. That's what it is. And, those 0 day to expiration ones, you're going to find that people are going to lose. They're going to hit one big one, and it's going to encourage them to go back and do more. That's always a bad thing. I quit golf about 7-8 years ago. And the reason I quit golf is because if I'm not good at something physically, athletically, I get too aggravated. I'm too competitive. And I decided one day that, look, I either have to focus on getting really good at golf, or I got to quit, because otherwise it's too frustrating, not to mention too expensive. And so I quit. But golf lures you in because out of, the 70 to 100 shots you hit, you'll hit 2 really beautiful shots that look like they could have been on TV on Sundays at the Masters. And that lures you in to play more. That's what ODTEs do to people. They have one good trade. They're like, oh, I nailed it. I'm really smart. But the game is rigged against you. I shouldn't even, you know what? That's actually the wrong way to say it, Jason, because it's not a game and it's not rigged. The pricing is out there and it's honest. And when you're buying 0 day to expiration options, you should know by the pricing that you're getting sort of the lower probability outcome when you're buying 0 DTEs.
Well, I think the major problem here, whether it's sports betting on your phone, online gambling with sports betting or gambling at a casino, or these options bets you said, is a lot of inexperienced people. They're trying to get rich quick. It's FOMO, fear of missing out. It's YOLO. Absolutely. You only live once. And they see what this social media lifestyle, they see that younger people are doing expensive vacation, luxury goods, and they're like, I'm trying to get rich quick. But they don't have the trading experience like you. So they don't realize that they're taking on all this debt, the leverage and the risk, and they're taking low probability bets, and the odds of them losing are very, very high.
So I'll tell you a story. A guy who's pretty well known in that world, right? He sells option signals, okay? And I want to throw out there, it is not Prosper Trading. That is a very good operation. My buddy Scott Bauer there. They're legitimate, honest people. This is a different guy. And he invited me for lunch one day and he said, I kind of want you to work with us. I said, okay, great. So we sat down and said, so tell me your model, so to speak, right? And his model was, he goes, I buy way out of the money calls and puts and call spreads and put spreads. He goes, and I lose on most of them. He goes, but when I win, they're very big winners. And then I am all over social media bragging about my win, right? He goes, and he was charging, I think it was somewhere around $250 or $300 a month for people to be in his service. He goes, so when I post one of these big winners, I get a ton of new signups. And I take that money and I put it in my trading account. And I start doing all kinds of crazy trades again. He goes, and usually those are all losers. And most of the people don't quit because they're trying to make their money back from the losses we've just had. He goes, so I'll get 2, 3, 4 months out of those people. And somewhere in that time, I'll hit another big trade. And I'll put that all over social media. And I'll get a bunch more new subscribers. None of his trading account was his own money. It was his subscribers' money that he took from them and then put into his trading account. And then when he would have a big hit, that would be his money, right? And he'd buy his Lambos and his Miami condominium and all that stuff. But it was his members that were paying for it. And he wouldn't publicize his losers, only his winners. And he said again, he goes, even when I have a bunch of losing months, I have very little turnover because the people who joined when I had a big winner keep waiting for it so they make their money back.
So you're saying it's like the gambler mentality?
It's disgusting, Jason. Yeah. I mean, they're just up there and they're like, I need to stay at the table until I make my money back. Right? Exactly what you just said, the gambler mentality.
So they're not cutting their losses and they're not thinking like, am I doing something wrong? Is there something wrong with my process here? Should I cut my losses, move on?
This guy's process who is selling me a $300 a month product. You know, he's a charlatan. And they don't see it because they just want that FOMO, like you said, that YOLO, like you said, you very aptly said. And that's what they do. And I said, okay, I'll go home and think about it. Obviously, I didn't go work there. I couldn't because I need to sleep at night. But it was just it was a complete catastrophe of an operation that only benefited the guys who own the operation.
Well, the newsletter industry, a lot of that's like that. I worked at a larger newsletter company for a year in the past. I was the competitor to Agora Financial and Stansberry. And I mean, a lot of the marketing tactics, I used to sit in the marketing meetings. I was an investment analyst there, but I'd sit in the marketing meetings and I'd read the marketing copy and all the customer service phone calls would be about like the predatory marketing and stuff like that for marketing the newsletter, selling the sizzle over the actual steak.
Yep. It was unbelievable. I was actually I had a newsletter service reach out to me asking for option signals. So I said, I'll tell you what, I will send you the options I'm doing and I will send you the entries and the exits. You guys do what you want for them, but I just give me a flat fee. I'm a consultant. So we did that deal. And it's a lot of what I do now. So Path Trading Partners is a company that does analysis and content for small to medium-sized firms who want their own analysis, but they also don't want to hire analysts. So they hire us and they say, hey, we want coverage on these markets 3 times a week. Here's what we want it to look like. We do the analysis, we write it, they put their names on it, right? So I did it with these guys. He said, we want option signals, just naked options. Fine, but I'm only doing buys. I'm not doing sells. He said, that's fine. So I sent them out, right? I ended up getting one of their advertisements in my email by accident, and they were talking about their options algorithm. And I realized I was the algorithm. Now, I don't use an algorithm, right? I use my own methods, my own processes. But they were selling me as a mathematical algorithm they developed through AI.
Wow.
Yeah. I mean, it's ridiculous. Kept a lot of the correspondences in case it ever came back to me in some way, but
one of the newsletters was saying that like there was a CIA insider that you could benefit from trading on his top secret security clearance. So
I mean, come on. But like I think it's incumbent upon people like you and me to try and reach out to people and say, look, there's a line in Inglourious Bastards that Brad Pitt says. And he says, from Maynardville, where I come from in Maynardville, Tennessee, we got a saying, if it looks too good to be true, it ain't. In other words, it ain't true, right? And people, I don't know, man. It's like that FOMO you just mentioned is something they just can't get away from it.
So I want to transition now to your view on the macro picture and markets.
Yeah.
You've been through a lot of different cycles. Have you seen a cycle before where the dollar is rallying against other currencies? Other currencies are very weak against the dollar. It looks like other central banks potentially could cut rates and let inflation run hot with financial repression, where the real inflation rate in other countries is above the bond yields. You have a yield spike in U.S. Treasuries right now, the last month, and in gold prices in all currencies now, including the dollar, are rallying. Have you seen a macro environment like this before?
So the short answer is exactly like this. No, I haven't. So what I do is I try and simplify the regimes, right? So let's take each one of these one at a time. What people don't realize about gold is that gold is not just a safe haven, and it's not just the oldest currency in the world, and it's not just something that can be used for jewelry. It's an asset, right? And the one thing that people forget, that in the context of inflation, there is also asset inflation. Inflation is not just prices you pay at the grocery store. It's the value of your used car. It's the value of your home. And by the way, this is in dollar terms. So since the currency is being devalued, you may not necessarily feel it, but I'm talking about just in straight dollar terms, right? Value of your home, your equity portfolio usually rises in inflationary periods because it's an asset and we have asset inflation. Gold is also an asset. Okay, so what I see this particular regime to be is a reflationary regime, and I have seen those before. So what do I mean by reflation? Faster growth and faster inflation. All right, now we just got a GDP number that wasn't so good, right? Still positive, but 1.6%. If that were to go negative and inflation were to continue, we'd go into stagflation, which is what I was predicting for 2024 back in the end of 2022, which turned out to not be true, because I, among other people, were predicting a recession sometime in late 2023. Now, obviously, that could still happen, but the data does not point to it. I'm sorry, late 2024. Obviously, that could still happen, but the data doesn't point to that right now. So I still maintain that we're in a reflationary regime, and there's a number of things that point to that for me. Despite a tiny bit of softening, we still have a strong jobs market. Despite a tiny bit of balance between wages and inflation, we still have wage growth, and we have inflation turning back up. Okay, a lot of people were relying upon goods inflation to take the entire inflation regime down, and it did its job for a little while. But we're still on a 6-month or a 3-month annualized basis, depending on which one you want to look at. Core inflation is still running at between 3.8% and almost 5%, depending on which measure of inflation you want to look at, whether you want to look at core CPI or core PCE. And now we have goods inflation turning back up. You see what's happening with copper. I mean, copper is on it's in a very strong trend since the end of last year, and that trend is up. So in reflationary regimes, energy, basic materials, technology, industrials, those are the sectors that outperform. So I like crude oil, basic materials, I like copper, I like mining stocks, and I like gold. Technology, I'm not looking at technology yet, but it does historically outperform. But when you look at the range of outcomes for technology in a reflationary regime, it's anywhere from up 53% to down 63%. And that's in the sort of, 16 times or so it's happened.
Hasn't there also been a correlation, though, where like big tech Mag 7 has rallied and then oil prices are weak, the energy sector, and then there's when one of them goes up, the other one's not doing well?
Yeah, there is an inverse relationship with the Magnificent Seven and energy. I'm not quite sure I understand why, to be honest. But there is that correlation. I suspect it's because the Mag 7 isn't going to do well in an inflationary regime that the Fed responds to. And that's what I think is different about what we're in right now. The Fed is not going to respond with higher rates as of yet. Now, we do have an FOMC meeting next week, so it is possible that Jerome Powell comes out and says, by the way, not only are we not cutting as quickly as you guys thought, but we might even hike. That would change everything for me. But we'd have to talk again after that. But I don't see any way that he does that at this particular meeting.
Do you think so? That would in that scenario, that would make the dollar stronger, and then that would start to put pressure on a lot of companies and sectors in the regular stock market?
Absolutely. Absolutely. I mean, because that's what the stock market fears the most, is a radical increase in interest rates. That's what, especially tech and small caps, right? That's what they fear the most. That's why in those kinds of regimes, energy performs so well, because the energy sector, they don't rely that much on debt, right? Not as much as technology does and small caps do.
Well, oil companies used to have a lot of debt, but over the last couple of years, they've been focusing on paying it down. So all of the balance sheets for a lot of these oil producers have never been cleaner.
Yeah, they've really, really done a job on that. And, unfortunately, we've virtually changed our course on crude oil drilling, right? With the whole fossil fuel switch. And that's really going to harm us in the future if we cross our allies, in quotes, in the Middle East. They're actually going to be able to have power over us again. A lot of people don't know that, there's 4 or 5 different types of crude oil. So even if you are producing 20 million barrels a day in the US, you still need trade, because in the US we do low sulfur, what they call light sweet crude oil. That's the majority of our crude oil.
Yeah,
You still
Permian.
need heavy sour. You still need to trade with some of the companies that produce the other levels of crude oil that's needed. But you sort of become synthetically energy independent, because
Well,
the other economies need the light sweet.
So for our listeners out there, what Bob is describing is that the majority of the U.S.'s oil production increase is from the Permian Basin, and that oil is light sweet crude. So it's not as energy dense, but the refiners in the Gulf Coast, they want to mix that with heavy sour because it's cheaper. The inputs are cheaper, so Venezuelan or Canadian. So they want to mix it with heavy sour crude, and then they get better petroleum products and other products out of that.
Right, and they get better yields out of it too. So you can't just drill light sweet and be independent. You still have to trade.
Or you invest in nuclear power, Bob, and then you get cheaper forms of electricity, more consistent base load. So that's what I'd like to see. So we're not as dependent on those expensive oil imports.
Yeah, but now you're just being logical. Like, what fun is that?
Yeah, here in the DC metro area, they're not doing a lot of logical energy policy, not for
No,
decades.
they're really not. And that's how you know they're not serious about the stuff, right? Because it is quite simply the easiest, most cost-effective, cleanest solution is nuclear, and they don't even consider it. And that's how you know they're not serious people, that these things are just political, sort of policy wrangling. That drives me crazy, by the way.
Well, it's even worse than that. I mean, they're white collar criminals with law degrees. I call DC the district of criminals.
I couldn't agree more. I'm going to steal that.
Well, I mean, the ESG policy, what they've wasted. Biden, as soon as he got into the White House, he announced what this infrastructure bill, and I think they spent $5 billion on electric vehicle charging stations, and they only built 8, and they don't work.
They gave Ford a $9 billion loan for EVs, and they ran through it in less than 2 years. And they still are not able to profitably produce an EV. I mean, they have a decently rated EV in that Mustang Mach-E, which, by the way, as a car guy, disgraceful that they call that thing a Mustang. But it's not there yet. And when you try to force these things, they don't work. It's almost like Barack Obama's investment in solar that went belly up, just on a much larger scale. And it's just, anytime the government tries to get involved in markets like that, trying to direct which products we should be using, and tries to advise what companies should be paying people, you're talking about an entity that has never created anything, that is run by people that have never owned businesses and have never worked in the private sector for any length of time. And I know there's a few of them, but the people that have the 20 and 30 year seniority, especially in Congress, and the bureaucrats that have been in the federal government for 20 and 30 years have never worked real jobs. And they try to dictate what the private sector is going to do. It's ridiculous. It's like me trying to tell a sushi chef which fish to buy and how to cut it.
You're preaching to the choir here. I've lived outside the Washington, D.C. metro area for almost 25 years. And you're right. When people in Congress here, they go to the private sector, it's normally like it's some type of consulting job, or, I'm starting a lobbying firm. I'm going to leverage all my contacts inside the government and large corporations that are going to give me bribes or some other high salary so I can get them favors inside government spending in the government.
Yeah, it's obnoxious. That's what it is.
Well, it's the revolving door of corruption. And, the problem is when the government gets too big, then the parasite starts to eat the host or kill the host.
That's another great one I'm going to steal. You're robbed here, man.
Well, let's get your thoughts then on some macro themes. There's rumors lately about a sizable China devaluation coming. There's a lot of macro experts talking about this. Do you think that that's starting to drive a lot of the demand for commodities with China stockpiling copper, gold and silver demand in China, and other Asian, Indian and Asian countries? Do you think like a currency devaluation is a big theme for a lot of these emerging market countries?
I do. So number one, the whole central bank buying of gold has been led by these emerging markets. I know that the Fed has done it. I know that the ECB has done it, but it really is part of a de-dollarization move. Now, it's obviously too small to worry about, from a perspective of whether the dollar is going to get dethroned, for lack of a better word. It's likely not in our lifetime, but it is part of an overall de-dollarization move. And the devaluation of the currency then just takes it the next step to where they can actually sort of cheapen their own products going into other countries. It's funny, man, because people don't understand like the value of understanding currencies for just the average individual is lost on people. Understanding not only what's happening with different currencies, but what it means to what happens in their lives. Because the stronger the dollar gets, right, the cheaper that foreign goods get, and the less that people buy domestically. So while there are a lot of positives to a stronger dollar for a domestic economy, there are some negatives. And a devaluation in China starts to fight the prospect of changing the direction of the supply curve, right? It starts to fight that because it just becomes cheaper and cheaper and cheaper to do things in China. And that's sort of a hard opiate for global corporations to shy away from.
Well, you also have China talking about, the U.S. talking about putting tariffs if Trump wins the election. So that's a possibility. So China could devalue the currency. It's kind of what happened in financial history in the 1920s and 30s with currency wars, trade wars, neo-mercantilism, protectionism. We're kind of seeing a lot history rhyming again, potentially going forward.
That's interesting. People ask me who I'm going to vote for, and I'm like, is there an option for somebody who hasn't announced they're running yet? Because, obviously, if you hold a gun to my head, I have to pick between these two. I got to pick Trump. But just because Biden has been an economic and a social disaster, in my view. But number one, I don't feel like the president affects my life that much, right? But he does have effect on international policy. So when you bring that up, it's funny because one of the things that Biden railed against Trump for doing in 2020 was his tariffs on China. And then he didn't take them away. He left them. And, as we get closer and closer to the election, he's talked about more tariffs on China, like the
it's
Chinese
polling.
electric cars.
My
right?
friend, it is all about polling because the polling is showing one of the few things a lot of Republicans and Democrats agree on is they believe that a lot of people in polling say they're anti-China and they want the jobs, at least an attempt by the politicians to bring jobs back.
Yeah, it's crazy, right? And you end up with this situation where it's like, I really got to pick between these two guys. But I actually thought I'd be an RFK guy briefly. And then he announced his vice presidential running mate. And I said, okay, I'm out on that now. So there's really nobody for me. But when you look at it from that perspective, yeah, I think that there will be more tariffs on China because there's just not a lot of creativity in the political class to handle these sort of economic challenges. They have a playbook that's probably 4 pages.
And they don't learn anything from history, from the mistakes, because 1920s and 30s, you had currency wars, trade wars, protectionism, and that led to actual real war because the U.S. started putting restrictions on Japan's economy, started blocking oil exports and rubber exports, and a lot of other countries were doing similar retaliatory tariffs. It did not end well historically.
No, it's not the way to go. The way to go is to try and move closer and closer to simply free competition. And I'll tell you something that they do wrong all the time. I look back to the 70s. I was born in 1966, so I'm a lot older than I look. And I remember everybody smoking cigarettes. Literally everybody, right? My father, my parents, we turned 15, we all started smoking. Now, it never took with me, so I never really smoked. But from that perspective, I look at it and I say, okay, they started with this sort of public service campaign about how bad smoking was. They had videos of guys like Yul Brynner, who's an actor who died I think he died in the 80s of lung cancer. And after his death, he released a video saying, now that I'm gone, I tell you don't smoke. I'm convinced that if I didn't smoke, I'd still be here, right? Okay, great. They don't do that with sort of Buy America anymore. They don't. And that's the kind of thing that works. Open competition with other countries, and then this sort of nationalistic view of how you spend your money could be important. Quality products made in the US, where when you have to compete, on a real level, the companies actually started doing better. It happened to the US auto industry in the 90s, right? When they were just getting their clock cleaned by Japan. It wasn't tariffs that strengthened the US auto industry. It was literally competition with Japan that strengthened it. And that's learning from history. But like you said, they don't.
Well, the people in DC seem more interested in bailouts. I mean, what you talked about with the auto companies, that $9 billion loan, I mean, that sounds like a bailout. Sounds like the auto company wasted the money. They didn't improve efficiency, a new product or service. They didn't earn profits or free cash flow from it. Sounds more or less like a bailout that DC likes picking and choosing these large companies that are political donors or their voter base, and they're going to figure out bailouts. That's kind of really since 2008. A lot of it seems to be, oh, we need to bail out this industry. Oh, we need to save these large companies.
But it's definitely what it is, right? I mean, you can all go back to the financial crisis, 2008, 2009. Nobody went to jail that should have for that. And, we have laws on the books. They're called fraud laws that could have sent a lot of people to jail. And nobody went. I mean, literally nobody that should have. I think there was one conviction, and it was like of one rogue mortgage broker, right? Who was probably doing what pretty much everyone else was doing. That's the playbook, and it's discouraging. Jim and I talked to Michael Ferris on his show, Coffee and a Mic, a while back. Somebody you might want to talk to, but it won't be market related. And we just all three of us were just like, we're pessimistic because we're just so pessimistic about the political class and what they know economically and what they could possibly provide in the way of support to the U.S. economy to heal the issues that we're in. And we all basically came up with, there's nothing that they know how to do.
Well, they actually are very smart people here. It's just they believe in bad policies, and a lot of them, the political class, the politicians, the bureaucrats, are so greedy, so corrupt. Honestly, they care more about stealing everything and insider stock trades at this point and getting rich or getting richer. They do not care about smart long-term investments, especially energy, because we need cheap electricity. We need cheap power to power our economy for data centers, artificial intelligence, all these new electric vehicles, all these new technologies. But the policies are so bad, what they're spending the money instead on solar, wind, biofuels, bad ESG stuff, because they can steal the money or trade on inside information on stocks and take a penny stock up to $5. The insiders cash out, and then it's a government-sponsored pump and dump.
It's part of why I like commodities so much right now. I mean, you look at, for example, obviously our grid is a mess, right? Our electrical grid is an absolute mess. And I get really sick and tired of these guys talking about shovel-ready products. The one thing I will say for the Biden administration is when they launched their Chips and Jobs Act, which, by the way, if I were dictator for a day, I would outlaw naming these things. I would completely outlaw it because people are so lazy. They read it and they go, oh, wow, it's about chips and creating jobs. Perfect. I'm for that. I agree with that. They have no idea what it is. Similar to the Inflation Reduction Act, which was a spending bill, right? But they did actually allocate money to private industry, which is actually spending it to do some things. But they're allocating money in a way that you described earlier, and I don't remember what the context was, but it was in a way of giving it to their friends and their lobbyists. And, they're giving money out to companies that have money to go ahead and build chip factories here in the US. And it's just outrageous the way that they allocate money. I'm glad they gave it to the private sector, as opposed to trying to do things themselves that they just simply don't have the, let's call it experience. I won't call it knowledge or brains. We'll call it experience to do. And that's discouraging as well when you look at it from that perspective.
So from what you described, it sounds like you don't think that the people in power, whether it's the Federal Reserve Bank or the policymakers in DC, they're not going to cut spending. They're not going to allow deflation for a long period of time. And the new normal, we're going to be looking at higher levels of inflation, commodity shortages, either due to increased demand in China, India, emerging markets, or lack of investment on the supply side. Is that kind of the new normal you see going forward?
The way it sits now, Jason, if you ask me, our inflation range over the next 5 years is going to be about 2% to about 5.5%, because they're not going to rein in spending, in my opinion. And, Jerome Powell, I've had this argument with Jimmy where I'm kind of like sick of bashing the Fed. And Jimmy's answer is, oh, I've only gotten started, right? I think Jerome Powell is actually concerned about his legacy. And I think it's part of the reason he kind of wants to cut rates, because he'd like to see the economy be on a little bit more stable footing once he has to start rapidly hiking them again. And he's sort of like those people who kind of want dry powder, right? Because if he moves rates from, Fed funds rate from this 5 and change level that it is now, if he has to move it to 7.5%, 8%, I mean, there's a recession and it's going to be a long and a deep one. And so I think he kind of just wants a little bit more room because he knows he needs to do it again. But man, they say don't fight the Fed. Our federal government with fiscal spending is fighting it like crazy. And they're absolutely putting the Fed in a no-win position, which is why I'm tired of bashing them. Because I just think it's like hitting a 5-year-old in the head. Like there's nothing they can do.
Well, the Fed is a great enabler, right? So since the Greenspan Fed, they've been warning about fiscal DC spending, budget deficits. So like the budget deficits for many years were $1 trillion, but it really seems that, I don't know, the last 5 years that they put the foot on the gas. Every time there's a financial crisis, they just do more bailouts and spend even more. And now here we are, the budget deficits are I think over 2 trillion per year.
It is, and I think they're growing by about 100 billion a day, somewhere in that range. I mean, it's a crazy number. It might not be that much, but it's a crazy number. And when you look at it from that perspective, this is what I mean about the Fed. It's like so at some point, foreign governments are going to need to sell their U.S. assets, right? It's just going to happen. They're going to.
Well, Japan is doing it, right? Japan is selling
Japan's
treasuries now.
And they're going to need the money, right? And when they do that, the Treasury, it's going to be simultaneous as the Treasury needs to issue more to service the debt we already have. And so they're going to issue more. And who's going to buy them? It's going to be the Fed with printed money. So they're just going to print money and buy them. And, they don't really have a whole lot of choice in the matter. They sort of de facto, I mean, they're independent, right?
No,
you can see me rolling
they
my
say
eyes.
They're independent. It's just
you can see me rolling my eyes right now. I mean, they're not, right? They basically are an arm of the Treasury at this point, unofficially. And they're going to have to print money to buy these treasuries. And so it's an endless cycle of currency devaluation, and debasement is probably a better word. Currency debasement. And that's the part of inflation people don't realize. Is currency debasement is different than just a weakening of the currency, right? It's a structural decline in what the currency can buy. And that actually is a slightly different thing than just a devaluation. So, I mean, even domestically, you end up buying less. It doesn't even matter. You don't even have to compare it to the euro or to the yen or to the pound or to gold. It's literally domestically, your dollar is worth less against products that you used to buy.
And it looks like all these other governments and central banks are kind of all in this. We need to devalue or debase our currency a certain amount because that's kind of the central banker playbook. If they went to an elite business school, an elite economics program with a PhD in economics, that when they get in trouble, the solution is to devalue the currency. That seems like the main solution that they kind of pull out of the hat.
I'd like to send them all Economic Facts and Fallacies by Thomas Sowell and just say, you can't sell another stock until you read this.
That would be nice. I don't think they might use it as a doorstop.
Yeah, they'd never even cracked the frickin' spine of the book. It would look like new. It probably wouldn't even be fingerprints on the placket.
And I think that's why you have China and these other non-G7 central banks. This is why they've been buying a lot of gold tonnage the last 12 to 18 months. I mean, they were buying since 2008, but the amount of gold tonnage purchases each month has really increased since those Russia sanctions in 2022.
Man, it's funny, man. Like, I think you're younger than me. I'm pretty sure you are. And even you, I don't necessarily think are going to feel it to its full extent. But kids that are like 15, 16 now, and their kids, they're not going to recognize the country because fiscally, this just cannot continue. It simply can't. It's untenable. You get to the point where you print this much. And now imagine we go to a central bank digital currency, right? The CBDC is my worst nightmare. It really is. Because it is, number one, infinitely printable, right? Because you just jack up the level on it. And also, it's infinitely freedom devaluing, right? And we know that'll happen over time. So that's why, one of my biggest, I shouldn't say one of my biggest holdings, because that's not true. Stocks are still my biggest holdings. But one of my biggest holdings versus how much I normally hold is gold. And
Yeah,
I've had
gold,
that since
silver.
about November 2022.
Are you in like the same camp as Jim Iuorio, where he said like gold, silver, Bitcoin are like the best inflation hedges?
So I don't know about Bitcoin yet. I've been in and out of Bitcoin. I've made a lot of money in Bitcoin. I believe in blockchain technology. The one thing I can't get my mind around, and we're going to be talking to Natalie Brunell soon, so I'm going to ask her. Maybe she can help me with this. The government won't even let you say the wrong pronouns. Why would they give up the monetary system to another currency? Now, she's probably going to say to me, they don't have any control of it. As long as we transact with each other in Bitcoin, it won't matter. Okay, true. But I still can't get my mind around what Bitcoin, what its value is based on. And even gold, Jason, like even gold, I understand it. It can be used for things, right? You can make jewelry out of it. There is some industrial uses. Silver, even more so, right? It actually has function to it. Bitcoin, I can't get my mind around it. So you're just saying that it's limited in production and it's the perfect currency because there could be no fraud in it, although we've seen plenty of fraud, right? And anonymity, although we've seen that erode as well, because we've seen the government reach out through the ether, no pun intended, and grab Bitcoin from people and grab Bitcoin from criminals who have stolen it, right? So I don't know how much the anonymity actually exists anymore.
Well, all the transactions are on the blockchain code, so with your IP addresses. So unless you're a computer expert and you know how to hide your purchases and your IP addresses, they can find you and track you.
Seems like it, right? I mean, you're speaking above my pay grade now. I'm an old dude, but that's what it seems like to me. It is imprinted in some way, shape, or form. And I've had these conversations with people before, and they were like, "You can't carry $1 million of gold in your pocket on a train to leave the country, or a boat, or a plane." Okay, fine. But if we're at that point, where do I plug my digital wallet in to retrieve my Bitcoin? I mean, we're talking about like catastrophe, right? It stands to reason the grid would be one of the biggest parts of that catastrophe, wouldn't it? So
Well,
I don't know.
so
I'm a
when
believer, but I don't know.
So when the internet and electricity are fixed, like it's not going to go away per se, but yes, the internet can go down. There could be electricity shortages, but it's still stored on the internet. The thing is, like, so I've lived in the Washington D.C. metro area for almost 25 years, and I've gone to the DC Blockchain Summit, the conference, and you have the government employees speaking here. I think since 2015 or 16, I've gone to the conferences. I used to get free media tickets and go there. There's a ton of government employees that give speeches from Treasury Department, Federal Reserve Bank, Securities and Exchange, CFTC. They own Bitcoin. They just don't view it as a currency. They don't view it as competing against the dollar. They view it as like a speculative asset class and a new piece of technology. So they buy Bitcoin when it crashes and they view it as something that will go up. They just don't view it as competing against the dollar.
So, okay, let's expand on that a little bit then, because that's what I've done. Okay, I've bought it and I've sold it. In the Bitcoin that I've had, I've made over 300% on those trades. Okay, total. That to me is a great return. I'm not knocking it. And I do like blockchain technology. Now, here's the funny part that I always say to people. When somebody says they don't believe in Bitcoin, but they believe in blockchain, it means they don't understand what blockchain is. I love the technology. I just don't understand Bitcoin. I don't understand Bitcoin from a perspective of if you talk about it as it's not a competition to the dollar, then it's a storage of wealth, right? It's something to store your wealth in, theoretically, right? It's a safe haven. But at some point, your wealth is dollars. And at some point, at least for US citizens of this. So at some point, if you have to convert Bitcoin to US dollars, you are now trackable. Especially if we get a central bank digital currency.
Well, I mean, Bitcoin's really volatile. So I don't know if you could say 10 years because really like 2000, it started 2010 or 11. And then 2013 was the first time it hit $1,000. I don't know if you can call 10 years of time a full store of value, especially with the volatility in price. Also, like a lot of people are buying Bitcoin and holding it. They're not using it, transacting with it as a currency. They're not paying a lot of their bills in Bitcoin with the taxes and stuff like that. They're buying Bitcoin. They haven't read the Satoshi white paper about like how it's gonna hedge against all the fiat currencies and bank bailouts and stuff like that with the fixed supply. Most of the people who bought Bitcoin haven't read that. They're buying Bitcoin because they think it's going to go to hundreds of thousands of dollars or $1 million in the next 5 or 10 years. That's why they're buying it. So they're buying it to get rich or get rich quick.
Completely agree. And that's, I guess, kind of the issue I have with it. Now, again, I've bought it. I'll probably buy it again. I haven't bought it probably, well, my last buy was around 19,000 that I sold in the high 20s. And I'll buy it again. It doesn't matter to me what price it goes at because my method is position sizing is based on capital I want to put into the position. So, at 20,000, I might buy 10 units. At 40,000, I'll buy 5. It doesn't really matter to me what the price is.
Yeah.
So go ahead.
I'm just going to say I'm not anti-Bitcoin. I just think that I think it's stupid how a lot of the gold community and the Bitcoin people fight all the time. And that I think these things can complement each other, that like you buy physical gold and silver for different reasons than you buy Bitcoin.
I totally agree with that. The reason I buy gold is because I know what its value is, right? I should say I know where its intrinsic value is. So, it's been unassailable for 5,000 years. Now, maybe that changes. Maybe it does, but I don't know. I mean, the people younger than you and I certainly don't like jewelry anymore, but they still do in some of the emerging markets. So China and India, for example. And the value of gold is, gold as a commodity is limited. It is possible to find new deposits. But just like peak oil, which, peak oil is going to be 150 years from now, but, gold, it could become very scarce at some point. And, like you just said, central banks are going to go scrambling for gold at some point when there's not enough for them to just simply buy.
Well, also with gold and these other commodities, another major theme is the cost to produce these things keeps rising. So we're really scraping the bottom of the barrel for ore grades, for copper and silver and gold and a lot of these other key materials. These things are not going to be, there's not going to be cheap and easy where they find 1 billion ounces of gold at way below $1,000. Just not going to happen. Even they're talking about mining asteroids or something like that. We don't even have the technology for that for decades.
Yeah, totally agree. And so to your original question, am I in the same boat as Bitcoin, gold and silver and copper? I love copper. I like copper a lot. Okay, it's sort of a medium-term holding of mine. I'll get in and out of it, but the base position is going to be long copper for a long time for me. I think the reasons are obvious, right? You've probably talked about it with other people before. Silver, all of my biggest losing trades have come in silver. All of them. It is an asset that, again, I have no issue admitting after 30 some years, I still don't really understand it. So I'm going to shy away from silver and just buy more gold. So I'm gold, copper, maybe Bitcoin, and land. Now, I have land that I was going to sell recently and decided not to. So that's my holding in land. So I'm kind of waiting for that. And that's sort of, that holding is not necessarily going to change because I'm not going to buy land at the elevated prices that we have now. But I also am not exiting our land position like I had planned to a couple of years back. So that's sort of where I am with that.
As we wrap up here, can you please tell my listeners about the Futures Edge podcast?
Yeah, sure. It's me and Jim Iuorio. I'm more angry. He's more snarky. I think that's probably the best way to describe it. We have conversations with people across the spectrum of subjects. I would say that this podcast is probably 75% financial. And even when we're talking to somebody in the policy realm or in the health realm, we always try and bring it back down to strategy and economics and macro as much as we can. For example, last week we talked to Dr. Sean Baker, who's a carnivore doctor. It's kind of a weird thing to call him. He's a doctor. He was a former orthopedic surgeon who is sort of a proponent of the carnivore style of eating. He's been eating that way for 7 years. That's obviously not financial, but we do like to talk about health because both Jimmy and I are healthy older guys. And you could find it on essentially any podcast app. In terms of the financial realm, we talk to people like, Luke Groman, Jim Bianco, Cameron Dawson, Brent Santiago, just, Eben Muhlman, just a literal who's who of people in the strategy and economic realm. So we get into that stuff pretty hard. I also, by the way, Jason, for your listeners, I post the entire podcast on X under my handle, which is Bob_Iaccino. So it's always there first, and then it goes up on the podcast app later.
Okay, and we'll put your Twitter handle or X handle under the video in the information and description section. Thank you so much for your time. Unfortunately, I think things are going to get worse in DC with whether it's Trump or Biden in the White House. It's out of control, DC spending, and the Fed is the enabler. So the Fed, the people can say, oh, fiscal dominance or something like that. I mean, it looks like the Fed's, fiscal dominance just sounds like bullshit marketing spin to me.
Couldn't agree more, man. The uniparty is both a threat to democracy. So don't listen when they use that phrase.
Well, my view is that both political parties in DC are stealing as much as they can before the dollar gets too weak, and the foreign bondholders start dumping the treasuries and stuff like that. Because I don't see foreigners wanting to buy a lot of the treasuries that DC wants to sell.
Couldn't agree more, Jace.